So you want to build an investment portfolio that's stable, that kicks off regular income, and maybe acts as a bit of a shock absorber when the stock market gets crazy? Well then, you've absolutely got to get your head around the world of fixed income. But just knowing the basics isn't going to cut it. To really make it work for you, you got to go deeper. And in this explainer, that's exactly what we're going to do. We're going to pull back the curtain on the three core ideas: what bonds really are, how their yields actually work, and the single most important risk measurement in the bond world, a little something called duration.
So here's the game plan. First, we're going to start with the absolute fundamentals. What is a bond anyway? Then, we are going to spend some serious time on what I think is the most important concept in all of finance, that seesaw relationship between a bond's price and its yield. After that, we'll figure out what yield really means for your wallet, introduce you to a cool risk meter called duration, and finally, we'll tie it all together to see how this stuff works out in the wild.
All right, let's kick things off at square one. Before we can even begin to talk about yields and risk and all that, we have to be totally clear on what a bond actually is.
At its absolute core, a bond is just a fancy IOU. It's really that simple. You are the lender, and some big organization like the US government or a huge company like Apple is the borrower. See, they need cash to build things or fund operations, so they issue these IOUs. And in return for your money, they're making you two big promises. First, they promise to pay you fixed interest payments on a regular schedule. We call those coupons. And second, they promise to give you your original loan amount back, that's the principal, on a specific date in the future, which we call the maturity date.
Okay, so every single bond out there is built on these three key parts. First up, you have the par value or face value. Just think of this as the official price tag of the loan. In the US, it's almost always a nice round $1,000 per bond. This is the amount you're promised to get back when the whole thing is over, assuming the borrower pays up. Next, there's the coupon rate. This is the interest you get paid every year, and it's always a percentage of that $1,000 par value. So if you've got a 5% coupon, that means you're getting $50 a year. Usually they split it up and pay you $25 every 6 months. It's that predictable income stream. And finally, you've got the maturity date. That's the finish line. It could be in 2 years, it could be in 30, but it's the day the loan is officially done and they hand you back your original $1,000.
And now, we get to the golden rule of the bond market. I really can't say this enough. This next idea is everything. If you can just get this one relationship down, all the other stuff about how bonds are bought and sold is going to click right into place.
And here it is, plain and simple. When a bond's price goes up, its yield goes down. When a bond's price goes down, its yield goes up. They are literally on opposite ends of a seesaw, forever. This isn't just some random rule. It is the fundamental force that moves the entire multi-trillion-dollar bond market. You burn this into your brain, and you'll immediately understand why news about interest rates sends bond prices flying all over the place.
So how does this whole seesaw thing actually play out in the real world? Let's walk through it. Picture the situation on the left. Let's say market interest rates suddenly rise. That means brand new bonds are coming out with juicier coupon payments than the one you're holding. All of a sudden, your old bond looks, well, kind of lame. So to get someone to buy it from you, you have to sweeten the deal. You've got to put it on sale. You have to lower its price. Now, the new person who buys it pays less, but they still get your original coupon payments. So for them, the effective return, their yield, is now higher, which makes your old bond competitive again. Now let's flip it. Imagine interest rates fall. Whoa! Now your older bond with its higher coupon looks amazing. It's the hot new thing. Everyone wants it. So what happens? People start bidding up the price, pushing it above the original $1,000. But for the person who pays that higher price, their effective yield will actually be lower. It's a perfect seesaw every single time.
Okay, let's put some real numbers on this to make it crystal clear. Let's say you own a standard $1,000 bond and it pays a 5% coupon. That's $50 a year. Simple. But interest rates in the market just went up. Now brand new bonds are being sold that pay a 6% coupon, which is $60 a year. So think about it. Why would anyone pay you the full grand for your bond that only pays $50 when they could just go buy a new one that pays $60, right? They wouldn't. So to sell your bond, you've got to cut the price. Let's say you drop it to $950. Now look at it from the new buyer's perspective. They're only paying $950, but they still get that same $50 a year from your coupon. Their effective yield is now much higher than 5%, making your bond a pretty good deal compared to those new 6% ones. See? The price went down, and the yield for the new buyer went up. The seesaw at work.
And that right there leads us to a really important point. As we just saw, that 5% coupon rate wasn't the real return for the new buyer, was it? So if the coupon isn't the whole story, then what is? We need to decode the different kinds of yield to really understand what a bond is paying you.
So let's break down the three main flavors of yield you'll hear about. First, there's the coupon yield. This one's the easiest. It's just the interest rate printed on the bond, the 5% from our example. But it's got a huge flaw. It totally ignores what you actually paid for it. So next up is current yield, which is a little smarter. It's the annual coupon payment divided by what the bond is selling for right now. In our last example, that's $50 divided by the $950 price, which works out to about 5.26%. It's a better snapshot for sure, but it's still missing a big piece of the puzzle. It ignores the fact that when the bond matures, the buyer will get the full $1,000 back, a $50 profit on their purchase. And that's why the king of all yields, the one that really matters, is the yield to maturity, or YTM. This is the magic number. It calculates your total return if you hold that bond all the way to the end, and it includes every coupon payment you'll ever get, plus that final profit or loss on the principal. It's the whole shebang.
And this is the big takeaway. Right here. Whenever you're watching the news or reading an article and they say bond yields are falling or the 10-year Treasury yield just hit 4%, they are talking about yield to maturity. YTM is the industry standard. It's what the pros use, it's what traders look at, and it's what the media reports. It is the number that tells you what's really going on in the market.
All right, so we've got a handle on the bond itself, and we understand its potential return, the yield. Now it's time to flip the coin over and talk about risk. And in the bond world, the number one way we measure the risk from changing interest rates is with this really powerful idea called duration.
Okay, you have to get this next part because it trips a lot of people up. Duration is not the same thing as maturity. Not even close. Yeah, they're related, but duration is a very specific calculation. It's a measure of how sensitive a bond's price is when interest rates change by 1%. So don't think of it like a calendar measuring time. A better way to think about it is like a volatility meter. A high duration means high risk, a low duration means low risk. Simple as that. And check this out. This is where that risk becomes super real. There's a handy rule of thumb. For every 1% that interest rates change, a bond's price will move in the opposite direction by a percentage equal to its duration. So let's say your bond fund has an average duration of 8 years. If interest rates suddenly jump up by 1%, you can expect your fund to drop by about 8%. Ouch. And if rates went up 2%, you'd be looking at a painful 16% drop. The higher the duration, the bigger the price swing when rates move. That right there is the risk of holding bonds.
So, what actually makes a bond more or less risky? Well, it really boils down to three things. First, the most obvious one, is maturity. The longer you have to wait to get your $1,000 back, the more chances there are for interest rates to mess with your investment's value. So a longer maturity means a higher duration. Easy. Second is the coupon rate, and this one's a little weird. A bond with a lower coupon actually has a higher duration. Think about it this way. A bond with a big, juicy coupon is paying you back your money faster through those big interest payments. But a low coupon bond? It just trickles out a tiny bit of cash. So most of your money's value is tied up in that one big payment at the very end. That makes it way more sensitive to rate changes. And finally, there's yield. A higher market yield actually leads to a lower duration. That's a bit technical, but basically, when yields are high, future cash flows are worth less today, which pulls the bond's economic center of gravity closer, making it less sensitive.
Okay, we've talked about the bond, we've talked about the yield, and we've talked about the risk. Now for the fun part. Let's put it all together and watch how a bond actually behaves over its lifetime in the real world, where interest rates are always bouncing around.
This timeline is the perfect way to see it all in action. Let's follow this bond story. In year 0, a company, XYZ Corp., issues a new 10-year bond with a 4% coupon, and it sells for the standard $1,000. Now let's jump forward a year. In year 1, rates across the market have gone up to 5%. That makes the 4% coupon on our XYZ bond look kind of weak. So the price-yield seesaw kicks in, and the bond's price falls. You see an opportunity and snag it on the open market for just $950. A great deal. Now a couple more years go by. It's year 3, and the economy has changed. Interest rates have tanked, falling all the way to 3%. Suddenly, your bond paying 4% looks like a superstar. Everybody wants that higher yield, and they start bidding up the price. The seesaw swings hard the other way, and your bond's price shoots up to $1,150. You could sell it right now and make a nice profit, but let's say you decide to hold it. We fast forward to year 10. The ride is over, the bond matures, and all those price swings over the last decade, they don't matter anymore. XYZ Corp pays you back the original $1,000 face value, just like they promised on day 1. It's the perfect example of how a bond's price dances around over its life, all led by interest rates.
So what's the big takeaway from all this?
Well, smart bond investing isn't just about finding the highest yield you can. It's about really understanding that unbreakable link between a bond's price, its yield, and its risk, which we now know is measured by duration. They're all part of the same package. And the one thing you can count on is that interest rates will always be on the move. So, that leaves us with one final question for you to think about. Now that you understand how this all works, is your portfolio's duration ready for whatever comes next?